We are here for the last full week of market action for the year 2024. And we are going to end it with fireworks. It is a busy week of macro event risk, and we're going to go through what to expect here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And not surprisingly, of course, the focus for the markets, the last Fed policy announcement for the year, but that isn't the only thing on the menu. There's quite a bit more to contend with. As ever, if you're watching this on YouTube, like and subscribe, and also take a note that we now stream live on YouTube in parallel with the stream that you see on tastylive.com. So check that out, like it, comment on it, do what you will. And what we'll do is we'll first take a look at what the markets did last week to see if that can offer us any kind of lead into what is next here. Taking a look at the performance, we see another big week for the bond market. 10-year yields, 2-year yields surging sharply. But relatively soggy elsewhere. So the NASDAQ, again, managing to outperform, up 0.6%. Interesting catch-up in the NASDAQ here recently since the beginning of December, because, of course, while the S&P 500 and the likes of the Dow started to make new highs above their July top as soon as the second half of September, NASDAQ had been pinned under those July tops for much longer and really only started to break out at the beginning of this month through those highs to set new records. We have a degree of rotation then, perhaps, because the overall S&P 500 down 0.7% last week. Not a shocking sell-off by any stretch, and the overall index has basically gone nowhere since the beginning of this month. It's just been oscillating in a narrow range. But the NASDAQ, again, managing to do a little bit of catching up, having lagged in the preceding weeks to the start of this month. The situation for crude oil looks impressive with a 6.1% jump, but if we consider where we are overall, we're still locked within the same choppy 2-month range. So a big swing, but not much to show for it directionally. Gold wiggling a little bit higher after news that China resumed buying for its reserve account in November. That's tempered a little bit. Gold was up much more on this news. It came out over the weekend last week, and so we started the week very strong on gold, but that surge in yields ultimately erased most of the gain come the end of last week. But gold still managing to rise a little bit. In November, the first month that China bought gold for its reserve account in size since April. And up to April, they'd been buying hand over fist for 18 months. So maybe the start of something here for gold, but we'll have to wait and see. Euro giving us a vision of the dollar overall. That's, of course, the dollar's biggest counterpart, giving us a sense that basically the dollar did very little last week, edged up just a tad, 0.2% higher on the euro. A bigger gain against the yen, though, 1.4% decline in the yen. That, of course, as you get that yields surge, the yen sort of a perennially low yielding currency. So when interest rates go up around the world, especially led by the US, you get a sense that it starts to make sense to engage with carry trade strategies. That's borrowing for very little in yen and then using the proceeds to buy higher yielding assets, so essentially shorting yen to finance purchases of anything that yields more than the borrowed yen costs. And so that creates this inverse relationship between yields and yen. And if yields are surging, you would expect the yen to come off, which is, of course, exactly what you saw. Bitcoin just kind of marked time last week. All of this setting us up for the biggest piece of news that comes at us this week, and that's the Fed policy announcement. That surge in the 10-year and the 2-year, certainly not something that's disconnected from the markets repositioning and essentially finding themselves right back to those mid-November lows on bond yields where they arrived after 2 months of repricing, which we'll take a look at momentarily here. And so what this looks like is a repositioning for a Fed that is set to issue a quarterly policy announcement, which means that not only will they announce what they're going to do with rates, they'll also give us updated guidance, most importantly, an updated summary of economic projections that will tell us what they think is coming next. So the policy announcement itself looks to be pretty much a foregone conclusion at this point. 95.4% priced in probability in Fed funds futures that we get a 25 basis point cut. The history when the probabilities are this high suggest this is done. There is almost no way that there isn't a cut. And so that part of the story isn't really anything with speculative interest. This is not going to move the price one way or another, almost certainly, because the markets have long since priced in that this is going to happen. The larger issue, of course, is what happens with the outlook for next year, because when the Fed met in September to start off this rate cut cycle, which is the last time that they updated official forecasts, they of course met again in November, but there was no update then, they said they're going to cut rates by 100 basis points next year. The markets at the same time thought, actually, it'll be a little bit more, probably 130. So what we have here is the outlook for Fed policy for the remainder of this year in the gray, for next year in the yellow, and the sum in the orange. So what you see then is when the Fed is about to start the cutting cycle, that's right here, the markets think 233 basis points in total, of which about 100 basis points is this year. It then does 50 basis points in September, so that's halfway, another quarter point in November, and as we just saw, another quarter point is essentially a done deal. So the 100 basis points that we had right here, done. That leaves 130 basis points right here. Since then, the market has gone down by more than half to now barely 50 basis points in cuts next year. In other words, this has been aggressively reduced by a factor of 2.6. So not quite 3, but more than half. And so what we then end up with is the very simple question, does the Fed pace this? Does the Fed say, yes, you are right, 100 basis points was the wrong amount, and we need to adjust down by the equivalent of what the markets have done, which would be down to 38 basis points, give or take. In other words, between 1 and 2 cuts next year. Now, why did this adjustment happen? Well, when the Fed issued its initial foray here, it said 100 basis points this year, 100 basis points next year, as we just said. Market looked at this in the context of U.S. economic data that had been improving relative to expectations since late August. Of course, the Fed meets mid-September here, so somewhere here. By this point, the ship has turned. And says, hold on a minute now. The Fed is cutting into a hot economy. And what this means is inflation will go up. What you end up seeing is exactly that. If you look at the priced in expectations for inflation in the bond market, This right here is the break-even rates in 5 and 10-year maturities. This is the implied inflation outlook baked into those bonds, that bond market window in time. What you see is inflation expectations rise. You arrive at break-evens just as an information aside here by taking the difference between nominal and real bond yields at that same maturity, and that gives you the implied inflation adjustment to get from nominal to real, because of course real is nominal minus inflation. So you see these inflation expectations rise. You see the market after the Fed start to reprice policy accordingly. Bond yields rise, both the 2-year and the 10-year, so across both sides of the curve. You see the dollar rally because, of course, higher yields give it a better yield advantage against its major counterparts. That is until mid-November, where the move ostensibly runs out of steam because there's not much else to price in. So there's a little bit of a correction. Dollar corrects lower, inflation expectations edge down a bit, yields correct lower. After last week's surge, that is, of course, this right here. After this move, we have essentially reset back to where the Fed left us once the market took the 2 months to price this in. So we're back to where we were basically in mid-November at the top of these moves. Certainly on yields, almost on the dollar, almost on inflation expectations. So now the question is, okay, what's the Fed going to say? And which part of it is going to be new relative to these moves? Well, the Fed has told us in no uncertain terms over the past 2 months in all of its commentary. On the one hand, yes, we probably overstated how much easing is necessary. It made sense at the time, and we probably need to wind this back some. And on the other hand, the path of economic data recently has been exceedingly volatile, and we're not going to hang on one piece of data or two. We're going to look through near-term data volatility, and on that picture, we're very much on track to get to medium-term 2% inflation on the timeline that we wanted. In other words, the market has cut back by more than half its outlook for rate cuts next year, but the Fed probably is not quite prepared for such heroics, which means they cut back maybe by a cut and come down from 4 to, let's say, 3. If they were to come down to 2, they would only just meet market expectations, and narrowly at that. They would need to come down from 4 to 1, a wild swing for a gradualist-minded central bank. And that seems unlikely. So the Fed maybe comes down to 3, and what that starts to look like in the context of these most recent moves is, in relative terms, a dovish surprise. That might give you a weaker dollar. It might give you stronger bonds. It might give you another knock back, buy the rumor, sell the fact kind of a response in the context of recent price action. Gold prices may even find their way higher after the shenanigans late last week, where China's re-entry and the response to it was diluted. On the data front, at the end of the week, we're going to get a little bit of a piece into the puzzle after the Fed. The central bank's favored inflation gauge, the PCE index, is due. Expectations for a second consecutive month of re-accelerating price growth, 2.5% on the headline. The core expected at 2.9%. That's kind of a heady number. That would be the highest since April. But of course, we know that reflation is ongoing. We've already seen it in CPI and PPI, and inferring these numbers is relatively simple once the components of those two reports are out there. So there's probably not much surprise risk in these numbers. Rather, they may do more in their passing than their substance, which is to say, it is certainly notable event risk that the markets might be reluctant to front run. But once it's out of the way, whatever they decided was the drill down punchline for the Fed and whatever happens after, that's likely to get a window for continuation into the end of the week once this piece is in the rear view. And then outside of the US, the real critical bit to pay attention to seems to be the monetary policy announcement from the Bank of England. No changes seen on this side of the ledger, and the expectation that we're going to hold at 4.75%, as we see here looking down the curve, it has barely changed from where the central bank centered it back in early November, the last time that we had a policy meeting. And if we look at the way that this breaks down, then we see that there is about 70 basis points on the menu for next year. If we factor in this sliver of remote possibility that something happens at this meeting, unlikely though it looks, we come down to a net 3 rate cuts tilt for next year. Even if we just take the 70 basis points at face value, then you still get an 80% chance of that third cut. And that's been fairly steady here in recent weeks. Now, this, of course, amounts to something of a conundrum for the Bank of England, because on the one hand, the UK economy has been stalling. Since this narrow peaking at the upper end, let's call it, of the growth range this year, and going back to mid last year where we had this somewhat narrow acceleration from July, August onward, we can see that things have actually decelerated. And even if we look at the range from early 2023 as sort of where growth has been from about here to here, the highs are getting lower. So it does look like the economy is losing steam, albeit slowly. Over the most recent months here, September, October, November, December, we can see that what we end up with is a return basically to near standstill conditions. Services wiggled up a little bit in December, looking at data we just saw earlier today, but the situation in manufacturing has only become worse. So overall, the economy is basically treading water, having slowed into that state of affairs. But at the same time, data that's going to get released just ahead of the BOE decision here is going to give us an inflation update. And here we're looking for inflation to continue to tick higher, 2.6% on the headline, and a very unwelcome 3.6% on the core. If we consider sort of what that means in context, these are some rather heady numbers. 2.6 would be the highest since March of this year. 3.6 would be the highest since August. So there's a strange sort of thing here for the BOE where on the one hand, the economy is looking like they should be giving it more support, but inflation isn't going in the right direction. Moreover, the components of inflation that are particularly sticky seem to be those that come from the part of the calculus that should be the most responsive to slowing economic conditions. Hospitality, recreation, these should be things that are dependent on discretionary spending. And if the economy is slowing, discretionary spending should be drying up. It's been a few months already, but that's not what's going on. And so, with that in mind, Bank of England has quite a bit of a dilemma. Do they look at the growth side of things and signal more cuts next year? Or do they look at the inflation side of things and hold back? Perhaps even consider that they need to send a higher for longer sort of signal. How this resolves should be a very interesting sort of a catalyst for the British pound, which has pulled back basically to hover near the 126 figure against the US dollar and is now essentially holding within plus or minus 50 basis points or 50 pips rather around these levels. So we're at a critical juncture. If the Bank of England is going to opt for something more hawkish as far as the guidance is concerned, then we may well push higher here. And of course, the context of what the Fed is going to tell us will be important. Maybe looking back at the 129 figure here then as the initial objective. But if the Bank of England ultimately looks at the growth picture and says, we don't need to do anything in a hurry, we're going to let this inflation uptick be, well, then the path of least resistance is going to be lower. And then we're going to be looking at this low at just below the 125 level for a reference, where if that is taken out, 123 might be the next step down. And that is macro money for today. As ever, we are here every day, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may head therefrom. I'm on with Chris for Futures Power Hour Monday. That was earlier today. And then Friday, that's coming up. I'm likewise with Victor Jones for the Price of Truth on Wednesdays, back with Victor and Tom for First Call at the International Market Open and the U.S. Futures Market Open on Sundays, writing for the news and insights portion of tastylive.com and commenting sporadically on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. Once again, if you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Take care.